Andy Himmel, Managing Partner of the Restaurant CPAs. I'm thrilled to be joined today by Lauren Keller, Executive Consultant, Head of Content for Winsome Marketing, who will co-moderate with me and help keep everyone on track. Our first guest is John Hamburger, Founder and President of the Franchise Times, Restaurant Finance Monitor, and the Restaurant Finance and Development Conference, which we're going to talk about today. John sits at the center of the national restaurant finance conversation and has a unique vantage point into what lenders, investors, and leading operators are focused on. And Gary Shamis is our next guest. Gary is an accomplished leader and entrepreneur who grew his accounting firm SS&G into the 37th largest accounting firm in the country before its merger with BDO. And at the time of the merger, SS&G represented one of, if not, the largest restaurant accounting practices nationwide. So Gary's perspective comes from leadership and scale, understanding how organizations grow and how strategy becomes execution. Quick background here to the finance conference, which we're going to talk about. Each year, the Restaurant Finance Development Conference, usually referred to as RFDC, is where the industry's most important financial conversations happen. Many small and emerging restaurant brands are not always able to attend. Not because they shouldn't be, it's just because of limitations around resources, awareness, or time. So today's session kind of brings you into the room. This is an executive debrief from RFDC 2025, focused on the key themes that John Hamburger saw emerge during the conference and what those signals mean in practical terms for ambitious 1 to 10 unit operators who want to grow, scale, and eventually sit at the table themselves. And Gary will help us translate those themes into leadership level actionable takeaways. So thank you all for joining us. Lauren, thank you for helping me today.
Oh, absolutely. This is going to be such a fantastic conversation. I'm really jazzed to be here. And I know we have amazing insights that are on the way.
So one thing I'd like to dive into, something a little bit lighter before we kind of dive into the conference. So John and Gary, the two of you have known each other for a very long time. How did that relationship first start, and why do you think it's lasted as long as it has in an industry that's changing so frequently?
Well, I don't remember when we met, John.
Yeah, well, we met at RFDC, Gary, and Gary's firm, which focused on the restaurant industry. You know, for years, I kept looking for that firm that just did restaurants, and I remember talking to some of the big accounting firms about focusing on restaurants. And I first met one of Gary's partners, Brad Saltz, and then met Gary at our conference. And what he was doing at the time I thought was just brilliant, because the industry needed a CPA firm that, you know, where that was their focus. And that's how we met. I don't know, Gary, it was probably 20 years ago. So.
Yeah, I think it was probably more than that. It's probably close to 25 years ago. Yeah, and I remember from my perspective, I was always very entrepreneurial, trying to grow this firm, and we really liked restaurants. And Brad brought me to RFDC as an attendee, and Brad and I both were attendees. And my whole life, I'd gone into these conferences before, and every conference I went in, there was 1,000 CPAs at this conference. All my competitors were at this conference. So I go to this conference for the first time, and I walk in this room, and there's like 3,000 people, and there's not one CPA. And I just thought it was like the greatest thing that ever happened to me. And it was such a revelation to me. I walked the floor, and there was one CPA firm on the floor. You remember who that was back 25 years ago?
Oh, let me just think of this. It was probably, Deloitte had the valuation practice, and a few of their accountants used to come, but I don't know they would have been exhibiting.
Okay, you don't have to.
Who was it?
It was Mike Gottlieb from EY.
Oh, EY, okay.
Yeah, so I met with Mike, and I said, met him, and then so we ended up coming the next year. So it was EY, it was my firm. We obviously had different type clients, and ended up creating a relationship with Mike, and we used to send clients back and forth to each other for years in the space. So that was the first time we ever met at that conference. And then just I also owned a conference too in another part of my life called Winning is Everything, and that conference was like a small version of what John was doing of RFDC. So I was really intrigued with how successful his conference was. And then for at least a decade, we used to trade speakers. So I'd have a really good speaker, and I called John. I said, "You really have to talk to this one speaker." I think we had Captain Denny one year from United Airlines, and the guy from Zingerman's, Paul spoke one year. So we used to trade speakers back and forth. So that's how far we've gone back. Now we're both has-beens, and we like to play golf, and we play golf together in Florida. So I always look forward to coming down during the winter season to play golf with John.
So Gary, so prior to that revelation, did you have a few restaurant clients? Was that ever just kind of random clients, maybe people you knew around town?
Well, the way it happened was I started working for one of the big eight a million years ago, and I ended up going on a restaurant client, and I can't remember the name of them. John might, but there was the ones that used to, all the restaurants were like in railroad cars.
Victoria Station?
Victoria
Station, yeah. So that was one of my clients at Tushaross, and it was like, wow, this is pretty cool. And then I moved back to Cleveland, and we ended up picking up one restaurant client, and I'll tell you exactly what drove me to it. And any listeners here will kind of get this. So I'm you're an accountant, and think of your accountant, back then your accountant's wearing a suit and, very prim and proper and, kind of conservative. And I have a meeting with my client, Eric Hewald and Tom Lutz, and said, okay, I'm an early person. Let's start at 8 a.m. And they look at me. They said, we don't get to the office till 8 a.m. If you want to, the earliest we could potentially make it is 11 o'clock. So I said, fine. So I go at 11 o'clock, and I'm dressed, in my suit and tie and all that. And they both walk in with shorts, and they both walk in with their dogs. And it's like, wow, this is like so cool. These people are just not your typical client. And ever since then, the people who own restaurants really, it just resonated with me that, they just walk to a beat of a different drummer, and I absolutely loved it. And, those two led to another client and another client. And by 1995, when we got really serious about it, we probably had 15 or 20 restaurant clients in the Cleveland area, but they were all limited to our region and at that point in time. We didn't start thinking bigger until Brad joined us in 1995.
Well, I remember, obviously I was a client, but I remember asking you one time, why restaurants? And I think considering the audience, myself, you just kept it pretty simple. And I think you said, well, you guys can't help yourself. You keep opening more.
Well, I've always said that, and John, you could probably really relate to this too, but I have never had a restaurant client in my life that didn't want to open the next unit. Yeah. Never had one who didn't want to open the next unit. So, there's capital needs, there's tax planning, there's all kinds of stuff coming, and all of them just, doing the next one. For those of you who don't know me well, I do own an existing restaurant right now in Cleveland. It's gotten great accolades. I'm very proud of it. And we are opening our next restaurant March 1st.
Of course.
So we caught it. We're opening the next one March 1st, and different concept, but we had to do more than one.
That's funny. Well, so with that context kind of out of the way, I just think the relationship is really cool. I'm just going to dive right in. So John, from your vantage point at RFDC this year, what were the biggest financial signals or themes shaping the industry as we're heading into 2026? Like, what did you see continuously?
Yeah, our conference, Andy, it's about lending. What's going on in the lending market, and then what's going on in the deal space. And I'll just talk about each of those for just a second. On the lending side, most of the restaurant lending that's done is geared towards multi-unit franchisees. And I would say for the most part, banks are in pretty good shape right now. They got a lot of capital to lend. That's not an issue. The issue in the restaurant business right now is that a lot of concepts are having sales and traffic issues. And, if they have those under control, there's plenty of capital out there for recapitalizing a business or acquiring additional stores, making an acquisition. On the independent restaurant side, the smaller restaurants, say 1 to 10 units, you run up against the SBA, the Small Business Administration cap of 5 million, and that's pretty limiting when it comes to expansion. So restaurant companies have to look at other means of raising money to expand. Now, there was one interesting deal that was at the conference that was at one of the panels, and I know there's been a lot written about and discussed about crowdfunding, but there was a restaurant in Minneapolis, Chi-Chi's. A fellow in Minneapolis resurrected the Chi-Chi's brand and converted one of his Mexican restaurants to Chi-Chi's, and he's just killing it right now. But he was able to raise about $3.5 million in crowdfunding to get that location open, and he's got a second one he's going to open. So that was kind of an interesting thing for smaller operators. On the deal side, there's a reasonable amount of deal activity going on right now, although I would say that the private equity interest in the restaurant space has waned, from what it was, say pre-COVID and then immediately after COVID. And I think these sales and margin challenges that a lot of restaurants are having is weighing into that. There's a lot of interest in franchisors, large franchisors. Dave's Hot Chicken and Jersey Mike's got premium bids. But it's just it's a tougher environment right now. Small independents might have been able to sell their businesses for a high price, high multiple of store level EBITDA, in 2018 and 2019.
Yeah.
Today, they might be lucky to catch a bid. It's just, it's a completely different market right now. And anyways, so that's just kind of a snapshot of what I saw.
Yeah, I mean, one concern that I certainly have read about and seen and felt myself related to margin pressure and what that new normal kind of looks like for restaurants. And I know that's a little bit more on the operational, I guess, or on the execution side of the business, but was that a conversation that came up fairly regularly as to, what those challenges are and why someone might be faring better than someone else?
Yeah. Oh, yeah. That was front and center at the conference is margin, margin compression, margin pressure, however you want to describe it. What's happened, I think, is that the consumer has put a lid on the ability of the restaurant owner to take a price increase. They're really tight in terms of taking price. And so what the restaurant operators are faced with is rising labor costs. Food cost has been is becoming more stable, and in some categories actually gone down. But it seems like the operating costs, some of the different service providers to restaurants, those costs have gone way up. And so it's really impacted a lot of restaurant owners' bottom lines. And then you have the situation with soft traffic, and the bottom line numbers are a good bottom line's tough to come by right now. So that was talked about a lot.
Yeah, I feel like the status quo in general, right, of being able to do business at the same cost that you're used to is like gone for restaurants. It's so interesting though when I look at consumer behavior and how consumers are willing to spend money on experiences and like very unique experiences, things that they deem valuable. And they're happy to put their dollar behind that. So do you think that kind of these smaller, emerging brands are going to have to figure out better experiences, different kinds of experiences going into 2026 to kind of boost that traffic and hopefully regain some margin?
Yeah, that's a good question. To me, there's like a bifurcated market out there. You've got people in upper income that are spending money. They're going out to dinner. They're looking for that experience. And then about 2 years ago, you started to hear the CEOs in the we'll call them the fast food companies and pizza, that the lower income consumers were reducing their frequency. And I think this has really impacted a lot of the, we'll call it legacy QSR restaurants, and even Chipotle. When Chipotle is talking about soft traffic, it's a tough situation out there. And then you've got what's going on right now in QSR are these value wars. McDonald's has got this $5 meal deal, which is absolutely killing, Wendy's and Jack in the Box and some Hardee's, some of these traditional QSRs. But then by the same token, you've got beverage concepts, people waiting in line to spend, $7, $8 on a frothy coffee type drink. And, so it's a real bifurcated market. And the restaurant owners are, depending on where they sit, it's either the best of times or the worst of times. So,
One issue, and Gary, this is something I remember even talking about 3-4 years ago or longer. I felt that restaurants got too expensive a few years ago. And I think it became, you're trying to, sometimes you were seeing, year over year sales increases were really not traffic driven, they were price driven, right? People kept pushing the prices up. And now that the cost to operate is so high, do you see that as a concern for the industry that they're going to price themselves, certainly the middle of the road, not the QSR, not the fine dining, are they going to price themselves out? I mean, how do you manage that?
So let me talk about that, but let me kind of couple that with what Lauren said before about the experience. So I love the independent market. I've always loved that. The large franchise deals, the QSRs of the world, that never really excited me because it's a formula, it's a business, and there's really no, you don't have the culinary type experience involved. And I just love the culinary. All my friends and my wife, they say, oh, you're a real foodie, because, you like restaurants. And I'm really not a foodie. I really like restaurants because when you see a restaurant that can do all three things right, it's really very rewarding and very just so hard to do. And what are the three things? One is the experience, two is the food, and three is the service. Putting all three of those together is a very challenging. It's probably one of the hardest things to do in business is to put that together. And when I see restaurants do that, to me, it's just so inspiring. And then you get a couple of them, who John knows quite well. I do too, like the who am I thinking of right now? Somebody like a J. Alexander's, who does it really well, at at that very high level. Okay, people like that. There's other ones too at that really high level, the Hillstones of the world.
Houston's.
But only if you have risen to that level with those three elements going forward. In order to do that, you usually find that in a local or regional type restaurant. So I just kind of love it. When you talk about that, I look at my restaurant. So I love my restaurant. It's called The Last Page. In August, we were voted the best restaurant in Cleveland. We've had great accolades. We're doing really well, continue to get better. And my restaurant is not too far from where I live. And my wife and I frequent it often. But I go in that restaurant, my restaurant, and none of my friends are in the restaurant. It's hard for me to go in my restaurant and see somebody I know. And the reason is because our restaurant really ties so much to the experiential side. And the people who really value that are people who are 40 years and younger. And they value it. Pricing is as much an issue. They just want the whole thing coming together. So when I go to my restaurant, that's what I kind of see. But there's one element of that if you play it the right way can be very productive, and that really gets to that $8 drink or maybe the $18 cocktail. And these people really like the $18 cocktail, the special kind of programs that are built for the internal liquor type programs there. So at my restaurant, what we see is we're 60% food, 40% liquid. And if you could have a restaurant 60-40 liquid, you're going to have a really successful restaurant. I remember talking to the CEO of Dunkin' Donuts, and the CEO of Dunkin' Donuts tells me, this is actually what a dinner I went at RFDC, says if you could serve it and it's liquid, you can make money. If you have to cook it or make it, you're not going to make any money on it. So the whole idea of restaurants being successful are these ones, that can really, and I think there's an audience for that. This millennial audience is very strong for that. But you really have to, kind of reach out to them on, the three levels I talked about.
I think that makes so much sense. And, I have a stat here that I'm trying to find. So it was Open Table's year-end forecast, and they found that at least over this year, dining was up 8%, and people plan to eat out 10 times per month going into 2026. So I think that there are people there who want that experience and who are ready to go and spend. It's just it to be well curated and very tailored, to your point, Gary, for the audience.
Yep.
I wonder as I'm listening to this, for years I felt that the independent restaurants were working really hard to, or maybe it was just me, trying to emulate what the chains were doing, right? I thought that was so fascinating, certainly on the full service side. And as, Gary, as I'm listening to you, it seems like really the independent restaurants have a huge opportunity to differentiate themselves with all the different offerings, certainly on the beverage side, to stand out more today than they probably ever have. John, I don't know if is there any thoughts you have, independent versus chain?
Yeah, I would agree with that. And the one thing Gary said that caught my attention was when he said when he was in visiting his restaurant and doesn't see his friends, but he sees a lot of the 40-year-olds in there. I think one of the things that it's an advantage actually for an independent is that with the generational shift that we're seeing, where the restaurant business was built on baby boomers and
Right.
and now now you've got a different generation coming into these restaurants. A lot of these legacy type brands, it's difficult for them to make the changes they need to make. Whereas the up and coming type brands, we'll think of like Dutch Bros, or we think of Seven Brew. Some of these concepts come along with that customer in mind. They've got a tremendous advantage, and I think that's where the independent has an advantage.
So across the board, I mean, you're almost really seeing that audience is really picking and choosing winners in a sense. They're choosing places that they think are worth the money that they're going to spend, and very often it's not the large chains probably anymore.
Yeah, well, I think you go back to when I was in my 20s, and I grew up on fast food, and then in the early 80s when we all started working, that was when the casual dining just took off, and everybody wanted to hang out at a TGI Fridays or a Bennigan's,
Right.
Or they would take their family to Olive Garden, and now that baby boomer generation is not calling the shots, in the restaurants like they used to, and a new generation is, and that's where the action's going to be and the growth is going to be, and you see it now. Like look at McDonald's. I mean, McDonald's is testing beverages all over the place, trying to figure out how to play in that market, and some of the brands can adjust, but it's not easy. Especially when you got a large franchise network, try to get them all on the same page is very difficult.
Well, we're seeing so much of that where these brands that have been around forever are now failing, and there's so many of them that are happening, right? Even Wendy's right now, because they're having a really hard time adjusting, and you're seeing that shift there. Going back to the fact that when I talk about my restaurant and everybody I go see there is under 40 years old, my partner, he's actually 40 years old. He says, "Oh, we just can't get all the older people." And I'm telling him, I said, "Well, why do you want the older people? The older people are older. I mean, they're only, their runway is not as long. When you're getting these people under 40, and if you could continue to accommodate them, that's the people you want. And they really value the experience. I think as a restaurateur, you really kind of have to look at the market itself, because I think the market has really defined itself and has changed drastically. And this whole millennial generation is one that really appreciates the kind of, they appreciate this upper end dining if you can do it right and play with it right. The QSRs of the world, they can't play that, and they're getting killed. Those people don't go there anymore.
Well, the QSR business is also, if you think about how QSR's changed over the last decade, and there's very little action in the dining rooms now. I mean, it's essentially it's essentially a drive-through and a delivery and a takeout business, and you've got these big investment in these facilities that have got seats in there for 40, 50 people that nobody's sitting down, and when you drive by them, they look empty, and so it's a different world that a lot of these guys are used to.
You're right, and a lot of those are in locations with AAA rent levels in premier locations, and they're spending a fortune. You're right. After COVID, to see more than 5 or 6 people in a dining room at one point in those restaurants is almost unheard of.
Yeah.
Being an old person, I don't get it at all. I mean, I just don't get it. my son's 40 and my daughter's 37, and we go to visit them, and and the first thing they're doing is like, they didn't make anything for dinner. We know that's not going to happen, and they're going to want to go and pick up dinner somewhere else, and we're going to call one of the food people to do it. And when you get the food, it's always, to me, it's just always terrible. This food it isn't built to travel 45 minutes and then eat it. It's built to be made and consumed right there. And you have this huge shift that I don't understand, but it is there. And years ago, John, I remember this very distinctly, and I gave you a lot of credit for this. I never told you this, but I gave you credit for it. And that's when you started you pivoted your May conference to the delivery conference. What do you call the May conference now?
It's called Food on Demand.
Yeah, Food on Demand. And when you started doing it, I thought, what the heck is he doing? I didn't really get it. And you were really way ahead of the curve, because that's the way that it was heading, and it has been such a pivotal change in terms of the industry.
Yeah, and I think it makes so much sense when you look at the QSR landscape in general, because there was also just a new study that came out that said that the single most important factor for people going to a QSR right now is if the consumer deems it, quote, very cool. Like, coolness and being fresh, being hip, being a place you want to be is actually more important than the quality of the food, this one study found. So it's fascinating. So it's showing that, like, you have to invest in actually a good experience, and for the person themselves to feel like how you want them to feel. It's this aspirational identity that the QSRs have to kind of launch onto, like brand strategy 101, but it's fascinating.
Well, one other factor too that I think that's impacted. We'll move on from QSR here, but I just want to mention one other thing.
Yeah.
Is that you typically would open a restaurant in a trade area, and how are trade areas defined? They were defined by the mall, or where the office parks were, or where the residential wrapped around the restaurants. But if you think of delivery, somebody can be in one trade area and be selling 2 trade areas over, because they can deliver it over 20 minutes, half hour, 40 minutes away, and it has the impact of like if an additional 20% of the restaurants opened up, new restaurants, because now I can deliver the next trade area over. So it's really changed things, I think. And anyways, back to independence.
Well, one item, I mean, Gary, even just going with the conversation about delivery, and we both just kind of, and John, you touched on it as well. Was that a theme that came up? That's a huge part of the business right now. There's a new company called Loop AI that I've gotten comfortable with, or friends with some of their senior people. And the whole point of that company is to help reconcile and manage the finances related to delivery, which when I was still in the restaurant business, that was like the wild, wild west. I don't think we even reconciled the checks we were getting in every month. But I do wonder if at the conference, that's got to be a big conversation, because it's propping up, businesses. It's no longer an artificial thing, but it's the way of the future. But how do you, I don't know. That's a tricky one.
It's a huge issue, because not only do you have the reconciliation, the restaurant doesn't always have the data, where a DoorDash or Grubhub has all the data on the sale, and it's their customer. I mean, if you look at DoorDash, for instance, people order the food. DoorDash is who they're doing business with. It's not
Right.
the restaurant that's delivering it. And so there's that, disconnect between the customer and the restaurant. So there's still a lot of issues and a lot of things to be worked out. Restaurants are trying to be, the first party delivery source, but that's easier said than done if DoorDash has got a lot of your customers.
Yeah, I wonder from the if I'm developing a full service brand, and I have 2 or 3 locations, I'm looking to grow it. I want to be, someone that's, on the field to raise more significant capital down the road, and I want to position myself. Do I need to make a concerted effort to go all in with delivery, knowing that there's sometimes challenges with the quality, like Gary, like you mentioned? There's no way. I mean, a steakhouse, which never even thought about delivery, is now doing 20% of their business delivery. I don't know how many people are happy getting an $80 steak or $40 steak delivered to their house, but at this point, if you're an emerging brand, do you have to go all in with that?
Well, you don't have to do anything. And I think it just depends on where you see your, majority of your revenue going to come from. So you don't have to. And there's a lot of, there's a lot of successful operations. I mean, look at Olive Garden. Olive Garden wouldn't do delivery unless it was at least a $75 order. And now they've changed, of course, but they took it slow, and so do a lot of other operators. They can take it slow.
You had mentioned early on that franchise groups were kind of more at the forefront of some of the capital exchanges and things that are going on in the market right now. But on the smaller, more emerging side, what are the types of brands that you see are getting traction right now, or what type of brands, and why are they still relevant in that space?
I think in the casual dining space, where there's they used to call it polished casual, a little more upscale casual dining. I think that's a good market to be in. You're seeing 10 unit, 12 unit groups in just about every major metropolitan area has got some success. I know I'm based in the Minneapolis area, and a number of those operations in the suburban markets are very strong, and so I think there's a lot of opportunity there. I mean, there's a couple of other brands. I would say they're maybe a little more quick serve oriented, that are independent run in pizza and cheesesteak sandwiches, things like that. So there's still a lot of opportunity.
So for some of the, just not to belabor the whole QSR thing, but was there a conversation about, changes to the structural side of these build outs, right? In other words, if they used to be 2,000 square feet, they're now looking to get down to 500 to 600 square feet. They're trying to combine with other locations. How are they looking to utilize the space in a different way as they're looking to grow and open new units? What are you seeing in that?
Well, I think what's interesting, Andy, is that I've been in the restaurant business around it for 40 years, and I don't think it's changed. I mean, operators are always looking for something more efficient, something smaller. I mean, back in the 80s, Chi-Chi's restaurants were in 12,000 square foot, boxes, and then they were trying to figure out how to get it down to 8,000, then 7,000. So I mean, this goes on all the time, especially now with the way costs have gone up. Construction costs to build have really impacted returns, and so you can either figure out a way to get more sales out of the box or get the cost of the box down. And, that's been going on since, Ray Kroc era.
Right. I guess this isn't really the most exciting topic to bring up, but in light of kind of what we're doing with the restaurant CPAs, I'd like to at least touch on it. Were there any tax themes or any changes discussed at RFDC that took into consideration maybe what's going on with the Big Beautiful Bill Act, or anything else that came up that you think is going to shape 2026 and moving forward?
There were two different sessions on the Big Beautiful Bill, and I think there's been a lot written about that, and some of the benefits to some of the tax savings that were extended, but yeah, there wasn't. I think there's been a lot written about that and a lot discussed about that, but we did have two sessions on that.
Yeah, I would think, well, Gary, anything in your world that you've noticed as relates to?
Well, I think the bigger issue or the biggest issue that came out of it was really not a tax planning issue, but was more a tax compliance issue, which is never an issue. And the tax compliance has to do with this tips and how are they going to do these tips and the guidance on it right now. Now this is something that the CPA firms are really not dealing with. It's the payroll companies, it's the ADP and the private payroll companies are doing it. And they're just starting to get guidance on it right now, or they started to in the last couple of weeks, going into January 1st. Yes. So, that's a really, really big issue, how to account for that, how to pay people. I think the tips are going to be doled out as usual. And what's going to happen is there'll be a part of your check will say which is the tip, and then that tip is going to go to a personal computation on your own return that will allow the tips not to be taxable if your income is below a certain level. But this is, that is one new element that's new, regarding the tax side of it. Other than that, I mean, I think everything that I know is still pretty solid in terms of structure and things like that. Not a whole lot of new things.
Yeah, I didn't know if there'd be any,
No.
It would fuel any type of expansion or any type of growth or investment now that, you can more or less write off almost 100% of the construction and all the related.
Yeah, you could do all rapidly, but that's been around now for a few years. That's really not new. Some of it's been retained.
I doubt that there's many restaurants, Andy, that are being built just because I can write it off. I mean, it's really, can I make money at this location is the driving, that drives decisions.
I'm wondering too, what's going to be most attractive to investors too. So if I'm an operator and I've got 8 locations, I'm looking to go to 15, and my books look okay, right? But we're saying that funding is pretty scarce in this area, margins are tight. Like what can I do as that operator to position myself in 2026 to potentially get those investors or get that kind of capital that I need to reach my goals?
It's a tough investment. If you go up market, when you're talking about these large franchises or franchisors, they're not restaurants, they're different, and people look at them differently. They look at the risk profile very differently. If you're looking at smaller restaurants, anywhere from 1 to 15, 20 units, it's really hard to do it. You try and create relationships with banks and hope banks will fund some of it, and sometimes they do. But when you're dealing with banks, what you see is banks change strategy and they change, they pivot all the time, and it's like, now they're friends. Oh, we're not going to do any more restaurant deals. So it's hard to build those long-term relationships with that. In my huge, long career in public accounting and also dealing with these restaurants, that was always just the biggest hurdle as to how to fund these smaller type restaurants.
Yeah.
The whole, you're mentioning the crowdfunding when we first talked, and all I'm thinking about is, boy, that's a really interesting way, but boy, that has got to be a freaking nightmare. And why is it a nightmare? Because now you have 3,000 people walk into that restaurant and they say that they're the owner.
Yep.
And because of that, they're looking for special treatment. And it's like, whenever I do a deal, it's like, let's have as few as people as possible, because I don't want people just coming in and saying, I'm owner, I'm owner, I'm owner. In crowdfunding, you could have, that could be the total opposite. So it's hard to do. I mean, the best way to position yourself, it's really pretty easy. Just make money. If you have a very profitable restaurant and you have historical financials that support that, and you know what you're doing and you can do it, you have a pretty good chance of doing it. But if you're trying to do it telling a story, it's a lot harder telling a story than showing positive results.
So unilevel economics, at the end of the day, what's going on in the 4 walls, that is the most critical piece to figure out, and how to refine the economic model, I guess, to create as much variability as possible and flexibility so you can adapt and change as things kind of change.
Yeah, I guess when I was talking before about the 3 things that are really important, I mentioned 3, but there's a 4th too, and the 4th is, if you do the 3 things right, are you doing them right enough to turn a significant profit based upon your time and investment to do it? So, and a lot of times we go to restaurants, we don't know that because we don't know what the books look like, but it's a real challenge. It really is, and the labor side of it, it's really hard. I mean, we can't find cooks at our restaurant. We just go through them left and right, and we have a great chef who's world-renowned, and you'd think people would want to work with him, and it's endless trying to keep people there. And I remember when I had the accounting firm, I used to look at the big 4 and say, how do they run a business where they have 25% turnover a year? I don't know how they do it, but they built the business to do that. And I had a business that we treated our people well. They recognized it. We had 8% turnover a year. And to me, that was so disruptive at 8%. And Andy, what was your turnover back in the restaurant that you used to have a year?
Well, at the time, for our restaurant, the industry average, it was around 100% turnover a year. And our objective was always to get under 100.
100%. I think it's higher than 100, to tell you the truth.
I think it was 120 at one point.
But it's such a challenging aspect, But if you build a really great restaurant with a great culture, you have people who want to stay there. They like working there. They're making enough money. So you got to put all these pieces together. but
Our
it's
top
really
performing
challenging.
restaurants in our company, our turnover was in the 30s. It
Yeah.
was significantly lower. Everyone made money. And really kind of, John, it goes to what you're saying. At the end of the day, if the economics are really good, the restaurant's busy, it's making money, that means the staff and the team are making money. And that's really that's half the battle. You know, when you're seeing I assume that there's certain restaurant groups or brands, John, at the conference that are kind of like the darlings, right? In any given year, the ones that everyone's kind of looking at and going, wow, they're really on top of their game. There's a lot of good operators. Is there anything specifically aside from just the economic model that they kind of have, whether it's tangible or not, that others can look at and emulate?
You know, Andy, it's when they got the great economic model, all that other stuff looks great too, right? When Chipotle was, it's got 27% bottom line, all you ever hear about is how great their food quality team is and their labor model, and everything just works. Everything works when the unit economics are working, right? And right now, everybody is all they talk about is 7 Brew, $2.5 million store level averages, almost 30% bottom line, selling beverages, and so they're the greatest thing right now, and it's just a function of who's doing it then.
I remember going to your conference a few years ago, and the big thing was the quick pizzas.
Quick pizza, sure, they've
I
all
remember
got.
you talking about that. I never understood it.
Yeah, and every one of them I think is out of business right now, and or pretty much so. And I used to go to that thing, and I'm a big pizza guy, and it's like pizza's local. You can't do pizza like that and be successful. And they were the hot ones at the top. At the conference, everybody wanted to talk to them.
And we've had bagels. Bagels now are making a comeback. There's a number of different new bagel operations with more of a quality bagel, and they're making a comeback. But I remember 30 years ago when bagels were the hottest thing. Everybody wanted to be in the bagel business, and so it just depends. It's beverages now, and we'll see what happens.
And when you say beverages, I assume that extends beyond just alcoholic beverages. It seems like overall drinking is the younger demographic is starting to kind of go down a little bit.
I'm talking about energy drinks, bubble teas, those types of drinks. I think Dutch Bros. I don't even think you can get a cup of coffee, black coffee, in a Dutch Bros. But you could get, you can get a cold brew, and there's a lot of different things you can get. There's a lot of those brands have popped up, and I had one. There's one called Swig, a company called Swig, and their number one drink is they mix a Dr. Pepper and a Coke Classic with a something else that's sugary, and it's pretty good, but it'll give you the zaps.
It'll give you a swig.
It almost seems like if you have a full service brand, if you can develop something proprietary or really, really cool on the beverage side, that could be such a huge driver from just to differentiating yourself from a bottom line standpoint, find ways.
You're only going to find that in larger groups, the Hillstones of the world. They may do something. At our restaurant, we could never do that. What happens is we rotate our beverage strategy every quarter. What are we putting on this time? And very few times does anything really carry over and really drives people wanting to come to our restaurant for a specific drink.
I want to kind of switch gears and kind of go, not this is more fun, but I guess a little bit more broad. So I guess, John, if you were to pick one thing that, in your experience, restaurant brands tend to worry about too much, what would that be?
Wow, that's a tough question. I
could give you an example of what mine was. I could tell you right now. We were so hyper focused on numbers and checking boxes with perfect tech stacks and everything that, that became more important than almost anything. And that's not how you make money.
The one that I would say that I've seen is where concepts are so focused on expansion that they kind of forget about the day to day. You can take a restaurant, say somebody's got 10 restaurants and 4 or 5 of them are doing well and the other 4 or 5 are so or losing money, but they always have in their vision that 11th store is going to be like the 4 or 5 that are making money. And so they're so consumed with building that 11th and 12th store when they've got, issues in-house with the existing restaurants. That's one area that I see people make mistakes.
Yeah. Gary, what about you? Anything that sticks out? If you're sitting here listening and...
I would actually try and answer that with the reverse. It's not what they look at too much. I'd say what they don't look at enough in restaurants. If you have a big chain, sophisticated chain, you have a large franchisee of Taco Bell, and you're talking about a J. Alexander, a Hillstone. From a financial standpoint, they know everything, and they run their restaurant based upon the financial reports. They get good data, they get data quickly, and they use that data. To the contrary, what I see is in the smaller chains, independents, 10 and less, that's their biggest weakness. They don't understand their financials. It's secondary to them. They don't have accurate financial statements. They don't interpret the financial statements correctly. As you know, Andy, you're running, some of them don't even have financials. They don't even know. They haven't run a financial statement in a long time. So, that's where I think it's just so critical for those kind of firms to have really good advisors around them that know the industry and are going to force them to do those kind of things. We see it all the time. I used to have clients that were out of business and they didn't know they were out of business because they didn't have up-to-date financial statements. I saw it all the time.
What?
Because they didn't know. They just kept going and not stopping to pay attention to it.
Dang.
So that's to me a huge element is that, I'm a big proponent on having the right. There's not a lot of companies in the United States that have the expertise on the restaurant space. I mean, there's certainly, there's dozens of them, but there's, 47,000 accounting firms, and most restaurants are being serviced by somebody who's not in the top 20. They're in the bottom 47,000 who have no idea what's going on. It was almost criminal. I mean, we used to get clients that didn't know how to take tip credits, and we get clients that didn't understand the quick depreciation that you should be able to take, or how to write off flatwares and things like that. Or taking some of the great new technology that you would get from some of the technologies that are available there that would give you such incredible information. Like knowing I sold, last week I sold 183 meatloafs, and the week before that I sold 170, and I only sold 32 steaks. What am I doing? And things like that. So I just think that this lack of sophistication on the financial side is just something that they don't pay enough attention to. And those that do have a much better chance of being successful.
Yeah, because that directly correlates with margin. That's just so much margin that you could recover right there. If you know what to write off, if you know what you're ordering, how much to order, whatever, then you're not over or under, ordering at that point. And then, wow, your numbers tend to look a lot better, when you know what's going on. So I think
totally right. And I think, Andy and John have seen, and I've seen a lot of it where, you would have people who would compute their food costs on a daily basis or a weekly basis, as opposed to never even knowing what your food cost is or how to compute your food costs. So there's a huge difference. And the higher up you go, the more they're sophisticated, they get that kind of information. The lower you go, they don't have it. And it's just a typical, you're in a small community. Hey, I need to get an accountant for my business. You ask your friend, who do you use? Oh, they're really nice. I use them. You go use them, and you have a restaurant. Yeah, they have, one restaurant client. They don't know what to do for it. So in today's world too, with really digital and the way we're communicating right now, there's no excuse for not having somebody who really knows what they're doing in the accounting space. If you don't have somebody local, you could find somebody not local anymore today.
Yeah, I wonder, John, why is the restaurant industry so challenged in understanding the value of specialized support, right? I mean, I don't know, it seems like a lot of other industries, it's an innate thing. You know, you're going to go and work with whether it's an accountant or a financial advisor, someone that really knows that space. Why do you think restaurants tend to be challenged in that regard?
Well, there's so much work to get a restaurant open, and you look at maybe some of the backgrounds of the people that are opening restaurants, and they don't have that financial background. They don't start with that. And that's probably good they don't, because
Right.
they're into food and they're into beverage and they're into hospitality and they're not into accounting. That's things that Gary is into. They're not into that. And sometimes they're successful, and those first couple of restaurants are good, and they want to keep growing, and they just keep adding to their financial deficiency each time they open more restaurants, and eventually it catches up to them. And so what Gary was talking about is that there is so much expertise out there that they could rely on, but they're busy. They're tired. I at the after a long day, they're tired. It's been a lot of work running those restaurants. So,
And a lot of them come from the background of chefs,
Right.
chef concepts. They don't know anything about it. Or a manager who's running a restaurant, they don't have that financial background. You look again at these bigger chains. I keep repeating myself here, but you look at the bigger chains, you look at the bigger franchises and franchisors. These are more business people, not restaurant people. At the lower end, they're more restaurant people, not business people.
yeah, that's exactly how it is.
Yep.
As I'm listening to this, as I look at the industry now, from the standpoint of not being in the industry, I find things like technology, um, AI, what exactly that means, and how I would build from scratch if I were doing it again, knowing what I know, but also integrating technology in a way where a lot of those things maybe could be more automated. John, is that a theme that you noticed, this year, just in terms of tech and AI and stuff like that?
Yeah, well, it. I would say that if you look at that independent restaurant market, typically they're not building it from the beginning, with technology, and let's just say delivery. They're not developing it with that in mind in the beginning, but it is something that, with the right help, before they get to be 10, 15, 20 units, they can start to implement some of that. And the smart ones do, they'll end up doing it. And but it is difficult, when you're first starting out, you can't have everything possibly set up, to be perfect from an accounting and tax standpoint. It's just not gonna happen. But if you're successful, you can move to it pretty quickly.
I think often there's a lot of, when I think about all the things that really make a business, a restaurant work, it's the people, right? It's always your own people, and then how that extends to the guests coming in. And Danny Meyer talked about that for 25 years. And I think the big question moving forward to look at is how can technology be integrated to better be able to spend time mentoring and working with your team. In other words, we used to have chefs sit in the office for hours entering invoices. You probably don't remember like that world, back in the day, but you'd sit there all day after a long shift doing that. And there's so many different services today that exist where it's automated. Someone in your team scans it, it reads it, and it just gets entered right into the system. So I think the real question will be, how can technology be integrated so that way there's more time, let's say, for the chef to actually be on the line and train and work with their team? How can the front of house spend more time, with guests in the restaurant? It seems to me that would be my biggest fear, is technology taking that away. I think the industry needs to look at it and go, how can that be integrated as a way to actually be with people more often? And it would seem to me like that's really the challenge that the industry has.
Andy, I think the industry's, I think a lot about that. I spend most of my time with my consulting firm in the accounting industry, and the implication of AI into the accounting industry it's enormous. It's huge. And if you look at it and you say, you have all these levels of job, you start at level 1, you start at level 2, you get to level 3. The reality is that all the level 1 and all the level 2 jobs is going to be done through AI. They're going to disappear. So when you go into accounting, you're going to be starting at level 3, okay, which is more interpretation, communication, things like that. And so the teaching and the skill set has got to change as you go forward, because there's such radical changes. I've been trying to process this thought moving over the restaurant space since I started thinking about it in the accounting space. And I don't really see it. I just don't understand where I'm going to see it. I think, maybe with some of the fast food things, you might see some more robotics in place, where you see a robot making a hamburger at a McDonald's or something like that. But you're not going to necessarily see that in a high-end restaurant. You're just not going to do it, because a lot of it's based upon taste and things like that. So I don't know. I think there has been a tremendous amount of technology changes, and there will be, but I'm not sure that it's going to be such. But it's more getting more data to make better decisions than it is really cutting down the kind of work that's there. Now, I could be proved wrong, and someone's going to figure this out, but hospitality, is humans and it's people.
Yeah, it requires a human experience. It's
yeah,
hard to
yeah.
replicate that, at least at this point, maybe in 5 years.
So I'm not sure. But, on the same end as, having a good accountant, you should also be paying close attention, if you own these restaurants, as to what's happening on the technology side. Because there's a lot of, the amount of information you can get today running a restaurant versus 30 years ago, it's just so much different. Toast and Restaurant 365. I mean, they've totally revolutionized the data that's available that allows you to make better decisions.
Well, I hope for the industry's standpoint, John, I'm curious what you think. Maybe with the advancements in technology and the changes that so many service industries are going to feel, maybe restaurants are not a bad investment long term. It's one of the areas that maybe, yes, it'll be impacted, but maybe it won't change as quickly as they become obsolete as other industries might. But then on the flip side, you still have real estate that needs to be filled, so you just get more and more restaurants maybe. I don't know, but I can't see it changing too much.
Yeah, the barriers to entry in the restaurant business are fairly low.
Yeah.
And so if you can have a restaurant business, restaurant chain, small, that has some of those advantages, the technological advances, the right advisors, you can get a leg up on, say, everybody else.
Well, I think today's been just a fascinating conversation. I do look forward to actually going to RFDC next year. I did miss not being there. If a small brand wants to attend, John, in 26 or 27 and have a successful event in going and make sense of the resource, the committed resources and time, what should they focus on, let's say over the next year or the next 6 months, to be in a good position to make sense of it?
Yeah, well, I think it's good for small brands to go see what maybe their counterparts, the bigger brands, are doing, and some of the bigger independents. So I would just get it on the calendar and plan on attending, and try to attend as many workshop sessions as you can. Talk to as many people. You get the list of who's attending, so you can set up appointments, and that's what I would do. Is just really use your time out there well.
Yeah.
Yeah. My first time at. Oh, go ahead.
Also too, they have a trade show, and anybody who does anything to advance the restaurant industry is at that trade show. So if you're looking for technology, you're looking to create relationships with lenders, you're looking for a new payroll company, you're looking at someone for doing build outs in part of the world that you're not familiar with, you're going to find them at that conference. So the connections that you can make there and the resources that are available there, it is worth the price of admission.
Yeah, my first year going, I left and I just couldn't even. There was so much information that I had to download and make sense of, because there's so many great speakers and there's so many great opportunities to meet people there. So I am excited. I'm definitely going the next year, but I think this was a great conversation. I just love this. I hope we can do it again soon. I think what we've talked about today is a window into the financial conversations that are shaping the industry. You know, as a reminder, our role at Restaurant CPAs is really to help a lot of these ambitious operators find the financial foundation that they need to be able to be in those rooms and live in those spaces and be able to have those conversations. One note that I'll make, you know, my first year going to RFDC, every event that I had set up was because someone, whether it was Gary or someone in his firm who lived and breathed restaurants, set up for me and introduced me to. And I think as you're looking at different people to surround yourselves with as you're trying to grow as a smaller brand, it's more than just the accounting and the compliance work. Having someone that really lives in the restaurant space, they have the ability to network and introduce people to you, it really shrinks the industry down. And as a result of that, I left the first conference and I felt like I knew almost everybody in the industry overnight. So it really does help to go and see what everyone else is doing and get out of your own echo chamber, because you do tend to be with your own team and rationalize how great you are and how bad everyone else is. And then you get out there and you go, wow, there's some people doing some great stuff. So we'll definitely follow up with this replay and send out some tools for those who want to take that next step. So thank you sincerely, John, Gary, and Lauren for doing this, and thank you to everyone else for joining us.
Have a happy holiday, everybody.
And happy holidays.
Bye-bye.
Bye.